The US housing market's on a path to recovery while manufacturing has slowed, while in the Eurozone, the debt crisis has escalated. So what's in store for investors? Well, Paul Stewart, Head of Asset Management at Grindrod Asset Management, joins us in studio to share their economic and financial outlook for domestic and global markets. Thanks so much for your time. I think we're now going to continue the conversation from what we've just been having with Eugene. Let's get your sense. We can see whether you two differ on a number of views, and start with the US housing market, because we spent some time on it just a minute ago.
Sure. We would view the US housing market as bottoming and showing early signs of recovery at sort of an overall level. Clearly in the US, you still find vast pockets of property, particularly in the retail space and the residential space, Las Vegas, Florida, where prices still haven't bottomed, and there's perhaps still more pain to come. But at an overall level, it appears that the monetary situation, low interest rates, and more affordability, actually, frankly, after a long period of underperformance, is starting to catch up, and we're starting to see some signs of life in the property market. Slowly. Very slowly. So it's getting ugly at a slower rate.
Paul, I mean, something that this entire argument would be premised on is that obviously you've got the wealth effect coming through. As that housing market turns, consumers get that confidence back, and so they start spending, and that translates into economic growth. And in theory, that's entirely sound. But what we've actually seen through this deleveraging cycle is that you've actually had consumers rather rationalizing, repairing their balance sheets. And that's a very fundamental psychological shift. So it's almost as though, even though we see this, we might actually have that market stabilizing and turning for quite some time before we see that really start to drop through into a reversal of consumer spend down on Main Street.
Well, I mean, I think you've hit the nail on the head there with the word
well
deleveraging.
Done, Mohammed. You hit the nail on the head. We're all hoping to do that at some stage.
I think any conversation about global economics and global markets right now, from our point of view, has to be had in the context of a world economy that's still in the process of deleveraging. And so whilst housing markets appear to be showing signs of life, actually in general, consumer spending and retail sales haven't actually been that good. And that's largely a result of the weak labor markets in the US. So, we see companies still not wanting to go out and hire on sort of a permanent basis. We're seeing the swing towards contract workers and temporary workers and seasonal workers being very much a trend in the US and probably other places in the world too. So this is a very gradual process, and we've probably seen the worst, but it's definitely not peaches and apple cream just yet. And I think we've still got some restructuring to go through before we can actually clearly say that consumers are out of the woods.
Ultimately, do you believe that the central bankers are going to save the world?
Ultimately, I think central bankers are going to save the world. I mean, I don't necessarily think that it's going to be too much public capital has already been expended through this process for them to actually back off now. And one of the places where, I don't think they can provide any more monetary stimulus into economies, that's been done. But we're going to find, creative ways, the ESM, ESF in Europe.
Very creative ways, Paul.
Yeah, so actually taking toxic assets out of the system rather than actually providing liquidity to the system. And that's really where I think we're going to see increasing activity by governments, and particularly in Europe.
I mean, this is something I want to actually unpack, because that's what I've been saying for quite some time, is we've seen QE1, QE2, the impacts almost diminishing as we go along. And I always say, well, how do they change the game? They changed the game after QE2 by going with Operation Twist. And what it is effectively doing is buying us a little bit of time. I don't believe they're going to save the world all by themselves, but they're doing a very good job of continuing to buy us additional time and allowing the government to make the relevant fiscal moves that are required to get us the underlying growth coming through. But again, potentially looking at removal of those toxic assets from the system. What other potential ways are there for central banks to continue buying time for the governments to make the underlying structural changes?
Well, in the bond markets, particularly, you want corporates and individuals to actually start spending money again. That's the way you kickstart the economy. So,
that's why policymakers are trying to drop interest rates lower and lower to encourage people to spend.
So negative real interest rates is clearly, formalized negative real interest rates is clearly one of the ways that they're going to do that. And picking the pockets of investors effectively, where large pension pension funds in the US and Europe are forced to hold, government securities, and the yields on those securities are artificially low.
Akin to prescribed assets that we had not too long ago in South Africa.
Exactly, and that's really the picking the pockets of investors. So you're forced to hold these assets by regulation, and at the same time, the yields that you actually
is that not an indirect form of taxation on the saver? I mean, effectively, taxation rates in the US are at historic lows, and now they're saying, okay, if this pool's looking quite tapped out, let's rather go after the investors. Let's go after those lazy pools of money sitting around.
Indeed, of course it is, and if it's certainly a transference of wealth from the net savers to the net debtors. I mean, effectively, people that have been not risk averse are being punished now, and that's a crazy set of circumstances. But that's really the policy response that we can expect.
I want to throw forward to energy prices and where you think they're going. Are they going to continue to fall?
I'm certainly not going to try and make a guess as to where equilibrium prices are going to settle in the short term.
But broadly speaking, is the trend up or down?
I would actually broadly think that the trend is moderately down, but not massively down. So, and I'd probably say the same for commodity prices in general. I don't think there's going to be an Armageddon situation. I mean, China's going to continue to grow. Emerging markets in general are going to continue to grow reasonably robustly. And I'm taking out of the scenario, of course, where we have a complete implosion of Europe. That's not my base case scenario. So, that's why I say what I say. So I think you can expect commodity prices to actually, in the foreseeable future, to move downwards, but gradually and not precipitously.
Not fall off a cliff.
Not fall off a cliff. And I think we will then have a second rebound or move up in commodity prices, and perhaps in 12 to 24 months' time.
Paul, I mean, looking at your positioning on various asset classes, I see you're mildly positive on equities, you're mildly positive on listed property, and then again, negative on cash and fixed income, obviously by extension. But, I mean, just to try and test your thinking, looking at the South African equity market, which again tends to be kind of the key focal area for a lot of investors, that's almost reached fairly toppish levels on a technical basis. It's at the tops that we've seen if you draw a line coming from 08 across now. What are you seeing coming through with regards to earnings? Because, I mean, that's really where the potential surprise comes. If we look at PE multiples, not necessarily extended, but your outlook for earnings in the local market.
So, I mean, we think earnings will probably grow, 15 to 20%. So that's down on the 30% plus, which we've seen over the last couple of years. Just to look at South African equities as a whole, I mean, when we say we're mildly positive, I think at an index level, that belies what actually is happening underneath that. You've got a handful of industrial stocks that are pretty expensive, PEs in mid-20s, and even if they have, the 25 or 30% earnings growth, that just justifies them standing still. But, conversely, if you look at, some of the financial stocks, some of the listed property stocks actually are not in that demanding multiples. They're probably going to have reasonable growth coming through. We've seen some decent results from some of the banks in the last little while, much better than people were anticipating. And we also think that people are becoming somewhat too pessimistic, particularly on the diversified mining stocks, Anglos and Billiton specifically. And you can look at commodity prices falling, but once again, our base case is they're not going to fall precipitously. So we think that those stocks, looking out 3 to 5 years on 6, 7 PEs, we think that you'll make money out of those stocks.
Mohammed asked the question of Eugene a little earlier, and that was that the rand is actually key to the South African economic story. It's been incredibly volatile, that we can't ignore because of the uncertainty globally. It's a risk on, risk off, and we're buffered by that trade.
Yep.
Where, though, will we find equilibrium in your view on the rand?
Well, we would probably be somewhat contrarian in our view of the rand, and once again, I'm not going to try and give you a view of what's going to happen over the next 3 weeks or 3 months, because
it's anybody's guess.
It's anybody's guess, and certainly, until some finality and some roadmap and some clear milestones are put in place from the European regulators and Parliament as to how they're going to, plot their way out of the current circumstances, all, non-developed market currencies are going to be volatile. But I do think that, looking forward slightly longer term, 12, 24 months, emerging market currencies have got much better initial conditions. We're not in the game of trying to deflate our way out of high debt and low growth scenarios. In fact, emerging market growth is probably going to be reasonably robust relative to developed markets. We've got an increasing middle classes. We've got good demographics in emerging markets. We would generally think that the emerging market basket, of which the rand certainly is part, will actually trade slightly stronger than people anticipate. And we think over that sort of secular time frame, our types of currencies and perhaps even our bonds will actually do better than people anticipate.